Non-current assets, the first example that we're going to do is perfect traders. Assume a VAT rate of 14%. The following list of balances was extracted from the books of perfect traders, a VAT vendor, as at 30 June 2013. Now, important, look at the date, 30 June 2013. Land and cost, and there were no movement in land during the year. Buildings at cost, furniture and equipment at carrying amount as at 1 July 2012. Vehicles at cost, accumulated depreciation, furniture and equipment on 1 July 2012, beginning of the year, and vehicles on 1 July 2012. Now, we have the furniture and equipment at our carrying value as at the beginning carrying value, as at the beginning of the year. We also have accumulated depreciation as at the beginning of the year. So therefore we can work out what was the cost price of that at the beginning of the year, being 600,000. Then accumulated depreciation on vehicles as at the beginning of the year. Investments, bank overdrafts, SARS, capital, profit for the year before, depreciation, trade and other receivables, trade and other payables, inventories, and 10% long-term loan. Now, what do they want from us? Required, calculate the carry value of the property, plant and equipment as at 30 June 2013. Again, look at the date and you will see that your trial balance or your list of balances has year-end balances except for those balances where they have identified separately. Calculate the carry value of property, plant and equipment as at 30 June 2013. Your answer must state the cost and the accumulated depreciation of every class asset separately. So basically what they're asking me here is, in other words, is the IAS 16 note for the financial year ended 30 June 2013. Good, so let's have a look at them one by one. Additional information. Buildings consist of factory buildings and offices in Edwin Park Lot 454 37 Lily Avenue, Springs Extension 4. The buildings were purchased on 2 January 2013 and are depreciated at 2% per annum using the straight line method. So as at the beginning of the year, we only had land. During the course of the year, we have also acquired the buildings. When? Halfway through the year on the 2nd of January. What was the value of the buildings? 2 million rand. So if we're going to work out our depreciation on the buildings, it is going to be 2 million rand multiplied by 2% for the 6-month period equals 20,000 rand. On 31 March 2013, furniture and equipment with a cost price of 100,000 exclusive of VAT that had been depreciated by 40,000 up to the beginning of the financial year, so that's our opening balance. So our carry value of that asset was 60,000 at the beginning of the year, was traded in at a loss of 5,000 rand as part payment for new equipment with an invoice price of 91,200 rand. Now the word invoice price should indicate to you that that 91,200 includes VAT. Furniture and equipment is depreciated at 10% per annum on the straight line method. Good, so let's do our furniture and equipment first. Furniture and equipment at the carrying amount as at the beginning of the year, 400,000. Furniture and equipment, accumulated depreciation on the beginning of the year, 200,000. So the cost price as at the beginning of the year, 600,000 less accumulated depreciation of 200,000, which will then give us carrying value at the beginning of the year of 400,000. On 31 March, equipment with a cost price of 100,000 and depreciated by 40,000 at the beginning of the year was sold at a loss. So what is my first question? My first question is, did I use this asset that I disposed of this current financial period? Did I use that asset during the course of the year? If the answer is yes, then it means I have to make provision for depreciation on that asset for the current financial period. So the cost price was 100,000, the accumulated depreciation up to the beginning of the year 40,000, which gave us a carry value of 30,000 as at the beginning of the year. We have used that asset for 9 months of the year. So therefore, at 10% per annum straight line is going to be 10,000 Rand, 100,000 times 10% for a 9-month period, and that gives us depreciation for the year of 7,500. So the carry value of the asset at the date of disposal was 52,500. We made a loss on disposal of 5,000 Rand. A loss of 5,000 Rand. So therefore, what we're going to do is we can work out what was the proceeds, 47,500. Now, why do we need the proceeds? Because we are not required to do the asset disposal account or the income statement, whatever. But what they tell us is that specific furniture and equipment was basically traded in. It was given as part payment for new equipment with an invoice price of 91,200 Rand. So the new equipment, 91,200 divided by 1.14, gives us a total cost price of 80,000 Rand. Again, depreciation is provided at 10% per annum times 80,000 for a 3-month period, which gives us 2,000 Rand. So the carry value of the furniture at the end of the year, 78,000. Now, you must remember that only 100,000 of the initial 600,000 cost price, which I had in the beginning of the year, was sold. That 400,000 there plus that 200,000 there. That gave us the cost price at the beginning of the year. So we've only sold 100,000 worth in cost price. So we still have the other 500,000 cost price, furniture and equipment on hand, and therefore we must also make provision for depreciation on those equipment. Good. We have sold 100,000 of the 600,000 which we had in the beginning of the year. So how much do we have left? We have 500,000 Rand left. Now, depreciation is provided at 10% per annum on the cost price. So therefore, 10% on the cost price will give us 50,000 Rand of depreciation for the current period. If we're going to add the total depreciation charge on furniture and equipment, it's going to be 7,500 plus 2,000 plus 50,000, which in total gives us 59,500. Vehicles. Now, in our trial balance, we had vehicles there at cost of 480,000 at what date? At 30 June 2013, at year end. And then we had accumulated depreciation at the beginning of the year of 153,000 Rand. Vehicles are depreciated at 20% per annum on the diminishing balance method, so the reducing balance method. What don't we take into consideration when we do the calculations of diminishing balance? Estimated residual values. Why not? Because it's included in the rate. On 31 March 2013, an existing vehicle with the original market price of 162,450. A market price means that was price inclusive of VAT. Was traded in for a new delivery vehicle with 205,200, and that one is also inclusive of VAT. So the cost price of that vehicle will be the VAT exclusive price. On the 1st of July 2012, the accumulated depreciation on the vehicle was 88,350. Now that was the one that we've sold. So that one's got to do with that one. Okay. An amount of 169,290 was transferred into the bank account of the car dealer at the same date. Now remember what I've told you. We have a trading transaction here in the true sense of the word. So we had an old vehicle which we have disposed of. So the first step will be to work out what was the profit or loss on the sale of the old vehicle. And then we had a new vehicle that we've acquired. So the second step will be to record the acquisition of the new vehicle and work out the depreciation charge on that vehicle. The third step in this question is that obviously I haven't sold all my vehicles that I had in the beginning of the year. I only sold one of them, which had that inclusive price of 162,450. So obviously I also have to make provision for depreciation on the vehicles that we haven't sold during the course of the year. So let's have a look at vehicles. Now on the vehicle that we have sold, the vehicle that I've sold had originally a VAT inclusive price of 162,450 and accumulated depreciation in the beginning of the year of 88,350. So the carry value of the asset as at the beginning of the year is 54,150. We have traded in this vehicle on the 31st of March. So the first question is, did we use the vehicle during the year? The answer is yes, we used it for a period of 9 months during the year. So my first step before I can dispose of the asset is to make provision for depreciation on the asset. It's on the diminishing balance method, so it's 54,150 multiplied by 20% multiplied by the 9-month period gives me 8123. So the carry value of this asset at the date of disposal was 46,027. Good. Old vehicle. Now we're going to move on to the new vehicle. The new vehicle was acquired at the same date, obviously, because it was a trade-in transaction, and it was worth, inclusive of that, of 205,200 rand. So if you want to record the new vehicle, was 205,200 divided by 1.14 equals 180,000 rand. On the diminishing balance, 20% of the 180,000 multiplied by a 3-month period, which gives you 9,000 rand. So that was the depreciation on the new vehicle. The question did not ask me to work out profits or losses on the disposal of vehicles because they didn't ask me the income statement. I only want the closing balances and the movements that took place on my non-current asset during the course of the year. So I'm not going to carry on and waste my time working out profits and losses and all kinds of rubbish like that. It's not required. Good. Now the last portion is I have to work out what was the depreciation on the vehicles that I had in the beginning of the year, which I still have at the end of the year. Now, very important, these balances was 30 June 2013. So that is year-end balances for vehicles. So the fact that I have disposed of a vehicle with a certain cost price means that disposal, that cost price of that disposed vehicle was already deducted from the 480,000 as at 31 March when the transaction took place. Also, the cost price of the new vehicle is included in the 480,000 because it's a year-end balance. So, because the old vehicle was already removed and we've worked out the depreciation on the old vehicle separately, we are not bothered with the old vehicle. But the new vehicle of 180,000 Rand cost price, that 180,000 is included in the closing balance. So we have to take that 480,000 Rand out of the closing balance. Why? To end up with a balance of the vehicles that we had in our possession in the beginning of the year and still have at the end of the year. So that is where the 300,000 comes into play. 480,000, I said, is the balance at the end of the year after the sold vehicle was sold, was processed. There's a lot of salts here. Sold vehicle was processed. Okay. Now, accumulated depreciation I also have to work out because vehicles is depreciated on the diminishing balance method. The accumulated depreciation on vehicles is the opening balance for the year, 153,000 Rand. So the new vehicles depreciation charge for the year is not included in the 153,000 because this is an opening balance. However, the depreciation charge on the vehicle that was sold during the year is still included in that value of 153,000. So that 88,350 Rand has to be taken out of our opening balance to end up with the accumulated depreciation of the vehicles that we had in the beginning of the year and still have at the end of the year. I need to work out the carry value because the depreciation is based on the reducing balance method. So therefore I need the carry value at the beginning of the year multiplied by the 20% will give us a depreciation charge of 47,070. So what is my total depreciation then on the vehicles? Well, it's going to be 8123 plus 9,000 plus 47,070, and that gives us a total of 64,193. Now, if you're going to present the IAS 16 note, and you might as well do that because the sooner you're going to do that, the better for yourself, although it is not directly the question that was asked. Let's complete the IAS 16 note as part of the question or the answer of the question, just to make sure that you know exactly how it works. Good. The IAS 16 note starts with the carry value of the assets as at the beginning of the year. And it says there you have to distinguish between the cost price of the asset as well as the accumulated depreciation on the asset. Now, in the beginning of the year, we only had land at cost of R1 million because that R2 million worth of buildings was acquired in the current financial period. There is no movement during the year and there is no depreciation that we are write off on land. So therefore that R1 million was there in the beginning of the year, was opening balance cost, no accumulated depreciation, nothing happened during the year, and at the end of the year we still had a cost price with a carry value of R1 million. Now, there is nothing wrong to group land and buildings together. So if you did group land and buildings together, it's not a problem. But let's just see in this question what the buildings was all about. We haven't had any buildings in the beginning of the year. We've acquired that building, R2 million, halfway through the year. We have worked out that the depreciation on the buildings for the year was 20,000 Rand. That's that 20,000 Rand. So at the end of the year, just do this, at the end of the year, what was the cost price of the buildings? The cost price of the buildings was the acquisition price of R2 million. The accumulated depreciation will only be equal to this 1 year's accumulated depreciation of 20,000 Rand, and that will then give us a total there of 1980 carry value for the year. Good. Let's have a look at our furniture and equipment. Furniture and equipment was as follows. At the beginning of the year, what did we have as furniture and equipment? It was a 400,000 plus the 200,000 cost price of 600,000, and the accumulated depreciation was 200,000 Rand. They gave all those balances for me. 400,000, 600, 200, and 400,000. Then what happened to furniture during the year? Was there any additions? Did I buy any new furniture? Yes, well, furniture, new furniture, there was the cost price of new furniture purchased, 80,000 Rand. Did I actually dispose of any furniture during the year? And if I did, I want to show it at the carry value of the furniture disposed of. So here I've disposed of my furniture and the carry value at the date of disposal was 52,500. 52,500. What was my total depreciation charge for the year? We go back here, 7,500 plus 2,000 plus 50,000, in total 59,500. Our cost price of furniture at the end of the year would have been our new furniture of 80,000 plus the cost price of furniture still on hand at the end of the year of 500,000. So in total, 580,000. Our accumulated depreciation at the end of the year was the 200,000 as at the beginning of the year, less that included there of 40,000 that was sold, less 7,500 because that was included in the 59,500 depreciation charge for the year, plus the 59,500 which was a depreciation charge for the year. So in total, 212,000. So the 200,000 less the 40,000 plus the 2,000 plus the 50,000 plus the 7,500 less the 7,500, and that will give you then at the end of the day the 212,000. Now vehicles at the beginning of the year, or they gave us actually the balance as at the end of the year, which was 480,000. So we know that included in that balance was the new vehicle that we've acquired during the course of the year, which was 180,000. But we also know that in the beginning of the year, excluded out of that figure was this vehicle that we sold during the year of 142,500. So at the beginning of the year, the closing balance, we're going to take out the new vehicle and we're going to add the old vehicle to get to the cost price as at the beginning of the year. The accumulated depreciation that gave me the balance as at 1 July of 153,000. So I'm just going to use it as that. Our additions of vehicles during the year, we had new vehicle for 180,000. So that is where the 180,000 comes into play. The carry value of the vehicles that we've sold during the year, there we've worked it out. That is for 46,027. And the total depreciation on vehicles, we've calculated it was the 8123, the 9,000 and the 47,070. In total, 64,193. Our carrying value at the end of the year, they gave us the cost prices at the end of the year. They've told us it's 480,000. Our accumulated depreciation at the end of the year will be for everything that we still have at the end of the year. And that will be the 171,000 is the carry value. The cost price is 180,000. Existing vehicles was 300,000. That's 480,000. Accumulated depreciation would have been the 64,650, the 47,070 plus the 9,000. That would have made up our total amount of accumulated depreciation of 120,720. The difference between the two gives me the carry value of 359,281. Now, here's the total column, and the total column, if we're going to cross cost, is basically the 1,000,000, the 400,000, the 289, which gives us a 168,900, and you're going to do that for each and every line item. What is important though, and that what I want to show you, is that on the face of the statement of financial position, you are only going to show assets, non-current assets. Under non-current assets, you're going to have property, plant and equipment, and under property, plant and equipment, you're going to have that total of 367,880. And then you would refer to this note. This note will accompany that, plus the accounting policy note, and in the accounting policy note, you will have to write down at what value do we actually account for non-current assets, in our case at the cost value, historical cost value. You should also mention that depreciation has been written off on an annual basis. You should be given the depreciation rates as well on the different classes of assets. Don't forget that we also have to give particulars of our property that we own. So we have to say land and buildings comprised of factory buildings and offices on R545, 27 Lily Road Avenue, Springs Extension 4. And that was Perfect Traders.